Town Bank Mortgage, NMLS number 512138, is an equal housing lender. This podcast is for informational purposes only. And now, the man born with a 5 o'clock shadow and with the NMLS number 2028201. He is a gentleman. He is a scholar. He is
Tyler Cralle.
Well, it was another phenomenal day for the bond market, and not just the bond market. Holy. Yes. Yeah, it was a pretty good day for markets across the board. Buy America in full effect, with both, like I said, bonds were up, prices, yields were down, and I'm pretty sure every single major index was up. I mean, not just up, but like record highs, record all-time highs. We had the Dow up 1.7%, S&P 500 up 1.79%, and then the NASDAQ up just under 2.6%. All-time highs. Now the Dow's at 54,000. You know what? I was looking. I'll explain why I was looking this up in a second, but the S&P 500, I believe, is now above where the Dow was after the '08 crash. Oh, man. But it was a good day for bonds. So it's a good day for us here on Wilmington Mortgage. This is the Wednesday edition. I, of course, am the aforementioned host of this podcast. Tyler Cralle, of course, loan officer, Town Bank Mortgage right here, Wilmington, North Carolina. We break down top stories impacting mortgage rates every single weekday, unless I just take a month off for whatever reason. And so we're here. And so, yeah, great day for markets. The 10-year was down just under 7 basis points. And that was after yesterday's, I think, around 6 basis points. So we've seen a 13 basis point move this week. And then equity markets are skyrocketing. And I think we still have room to go, only because I just saw CNBC reporting that Michael Burry is saying we're close to like a 1987 top. And he's almost become like Jim Cramer, where it's like everyone jokes about like doing the opposite of Jim Cramer. The inverse, Cramer index is apparently like very successful. But Michael Burry, who, yes, called 2008, was immortalized on film by Christian Bale. But since then, I don't think he's made one right call at all. He has called, I don't know how many crashes since '08 and has been notoriously wrong. In fact, I went back and looked because there was a famous tweet, because this was like when we were coming out of 2020. And so you had, all these people who were stuck at home, were watching movies like The Big Short and everything else, and everyone was getting into the stock market. You had that meme stock craze with GameStop and AMC and everything else. And so, a lot of people were really immortalizing, were really kind of worshiping, I should say, Michael Burry. And they were like, oh man, he's so smart. Look what he did with 2008. And so he was getting a lot of attention. And like I said, rightfully so. It was a huge call. He was defying all the odds. Everyone was telling him he was crazy, and he nailed it. Unfortunately, since then, he's just been wrong a lot. So in 2003, I remember this, 2023, the end of January 2023, he famously tweeted, "Sell." That was his tweet. And just to give you an idea of what's happened since then. So at that time, the Dow Jones Industrial Index was at 33,926. Let's just say 34,000. It closed today 54,085. So for those who don't want to do math at home, that is a 58.8% increase since Michael Burry was like, sell. 58.8% increase, 60%. So if you were someone, and so here's what's crazy is that now in order, so let's say you were someone who took positions. Now you wouldn't have been able to do this because you would have to short, these stocks, and you would have been margin called to hell. You'd have no liquidity. You'd be done. But you have to be super rich to be able to pull this off. Let's just say you had shorted the market after what Michael Burry told you to do, the market would have to fall 40% before you made $1. $1 before you started seeing actual profit. So 40%, you're just breaking even. And just to give you an idea, from top to bottom, the '08 crash, 45%. The stock market. Like I said, the Dow got down to, I think it was like under 7,000. So when I see Michael Burry saying like, we're at the top based on his last projections, we got some room to go. All right, way too much time on Michael Burry. All right, let's talk about what happened today, why bonds are up. A lot of it seems to be, well, one, it's the ongoing, what we talked about yesterday with Japan and the U.S. That's obviously good. But also Scott Bessent, who, he was the one that was, big supportive of the move with Japan. He's kind of out front and center on this. He was on Squawk Box on CNBC Tuesday morning and was talking about the Strait of Hormuz. And he said that the U.S. could be just days away. Just days away. We've never heard that before. Days away from reaching an agreement to reopen the Strait of Hormuz. He told CNBC, quote, "There is a chance we may have a deal today or tomorrow or the next day." No, just today or tomorrow to open the strait and move towards a more normalized position in this conflict. Asked whether Iran would be allowed to collect tolls on ships using the waterway, Bessent said unequivocally it would be freedom of movement. Bessent, of course, also touted why this would be so important, saying it's not just energy, it's fertilizer, it's refined products, it's the various industrial gases. We could see big relief trade as those prices go down. Absolutely. And markets clearly were a fan of this argument. To my knowledge, we have not gotten a deal yet as of Tuesday night. So we will see if anything happens today. Or like I said, maybe it'll be the next day and the next day. But we've heard this before. I'm not exactly optimistic because we've heard this before. Now, obviously, instead of Trump, it's Bessent saying this. So does that give it more weight? Maybe, because he hasn't been out there. We have reached a point now, and this is sort of, I think Washington Post had a piece about this, where, Trump's just back and forth, and we have a deal, we're going to annihilate Iran, that he's almost kind of, the markets aren't moving anymore based on what he said. So now they got Scott Bessent out there, who does have a lot of market credibility. There's no doubt about that. So now he's utilizing that. And I believe that's why we saw such a positive move in markets, was what Bessent had to say. Because other than that, there wasn't a ton going on. We did get a JOLTS report, which is always, I think, an important report. But it was not, no big moves. No big changes. No big changes to the labor market. The Bureau of Labor Statistics reported that job openings totaled about 7.359 million on the last business day of June. That was down from 7.54 million in May. And while we did see a slight decline, 7.54 to 7.39, June was still the third strongest month in the last 18 months. So sure, it's down, but it's down from like a year and a half high. So no real movement, no real weakening in the labor market. The industries that we did see an increase in, transportation, warehousing, and utilities added 97,000 openings. Federal government, 39,000. So for a while there, if you look at the jobs report, which we'll get on Friday, for the last 4 or 5 months, probably 6 months actually, it's been like federal government, so many people, they're the number one cause of negative numbers for the month. There's nothing crazy. Federal government employs a lot of people, so 10, 20,000 is not a huge number, but every month it's like negative. And so now we're actually seeing job openings increase. So maybe we're going to see a reversal there. Offsetting those gains were declines in wholesale trade, non-durable goods manufacturing, and mining and logging. Total separations, which include quits, layoffs, and discharges, that rose to 5.35 million, up from 5.26 million and was the highest level since March, so not a huge move. And then quits, which are always an important metric to see how workers are feeling about the economy. If people are feeling confident, they will quit their job, either having one already lined up or know they can get another one when quits fall. People are not feeling confident about the labor market. That rose slightly to 3.23 million, up from 3.15 million, and the highest level since March. So like I said, a decent report, not a huge decline, increase in quits, total separations also increasing, probably because of quits, but nothing spectacular. So no real changes in the labor market. And because of that, it is going to start. And now normally this report on its own would have probably had a negative reaction to the bond market, because the big concern, of course, the Fed has a dual mandate: interest rates and the labor market. And the labor market, which some people were concerned about probably a year ago, maybe a year and a half ago, that was, concern. We were seeing weakening. We were hearing about mass layoffs, and it never really actually became an issue. And we've seen surprising strength from the labor market, and we continue to see that. The fact that job openings, even with the decline, are still close to 18-month highs. We are in a low hire, low fire environment, which is something that Jerome Powell coined and had talked about. But until we start to see low hire, rising fires, it does seem like the Fed may be more focused on their other mandate, which would be inflation. And if labor market seems strong, no real issues, and you do have persistent inflation, why would you then not risk raising rates? And I think that's why I think the market would have interpreted this report as, okay, they're definitely going to be raising rates next time. But if we do get a deal, we do see some development in the Middle East, then we're in a situation where the inflation pressures, energy, are gone. And so then they don't need to do anything. We may see inflation fall on its own with a strong labor market. They don't need to do anything. And so I think that report definitely got more attention. But normally, if we had just gotten this report and that was it, then we would have seen a completely different story, where it would have been, rates are going up, but not today. Not on Tuesday. We did not see rates. We know we saw rates fall. I mean, and so, I mean, it's crazy. So it's, I mean, if you look at the chart, and maybe I'll put that up here on the podcast. If you look at the chart, it's like, I mean, just up, down, up, and now we're down again. And so, I mean, it's literally a roller coaster with what is happening with the 10-year, because it's not based on data. It's not based on anything really concrete. It's all sort of rumors and promises and, oh, we're making progress, but we don't know. So Bessent's telling us, hey, listen, markets, we're making progress. And he's got capital. I mean, he's got trust. And so they're like, all right. But if this ends up being a dud, I mean, in all honesty, I think that's why Bessent is out there, because I think Trump has sort of lost credibility on this issue because he's so back and forth. And so someone in the administration is like, we got to get someone out there to let them know what's going on, because Trump's just not moving markets the way he used to. And so Bessent, I think, is now going to be the spokesperson. Now, of course, if it turns out we don't have a deal and he falls in that same trap, then eventually the same thing will happen to him, where he'll speak and the markets will kind of go, we need to actually see something actually happening. And so, no doubt, that report was the big mover of the day. There were two great pieces in the Journal, both about what the U.S. is doing with Japan with regards to the yen. There was one by the editorial board that pretty much echoed what we talked about yesterday that Robin Brooks was talking about, and the problems with Japan and their overall problem, which is they just have too much debt and they're spending too much money. And so they basically are like, listen, Bessent can do all he wants, and that we can try and do everything we can, but there's a fundamental problem with Japan, and it's just they have too much debt. And they need to slow down their fiscal stimulus and find another way to grow the economy, because it's now reached it's a problem. And no matter what we do or Japan does, if they don't fix the underlying problem, which is their debt problem, which is their spending problem, they're just staving off the inevitable. But it will eventually happen. They will have a debt crisis. They will see hyperinflation, and there's nothing they can do. They can sell. They won't be able to buy enough yen to solve that problem. And so this should be like a wake-up call to policymakers. Well, not just in Japan, but globally, because Japan's the first card of this house of cards. I mean, you look at all the economies around the world. I mean, we're not as bad as Japan, but we're all getting there. We're moving in that direction. So this should be kind of a wake-up call for all of us here. All right. It is Jobs Week, so we will be getting private payroll data. So we'll be talking about that on tomorrow's show, and I think that's it. I think that's all we got. So we'll keep you informed, as we always do, but you guys enjoy your Wednesday. We'll be back here Thursday for another edition of Wilmington Mortgage. And remember, as always, do not wait to buy real estate. You buy real estate and wait.